interest rates go down, usually that means that it'll kick into overgear, people being, companies being able to invest. They can borrow money at a lower cost. And so they're able to do more things. And, it brings the economy back before the economy stalls out.
And welcome into Protect and Grow Chicagoland Retirement with Chicagoland's certified financial planning professional, Tim Stearns, CFP, your guide, Chicagoland, for proactive guidance, advice, and insight on your money, on your investments, and on how to plan successfully for retirement. Tim, we always appreciate your guidance and insight. Thank you for being here on another great edition of Protect and Grow Chicagoland Retirement.
Well, Peter, thanks for having me. It's good to be here.
It is a pleasure, Tim, and we always appreciate the insight, as I mentioned. Now, a lot going on in the financial world. Maybe top of the list, at least here recently, has been this government shutdown. At least as we are recording this program, still ongoing, and it does not look like it's going to be over anytime soon.
Well, the last one was 18 days in his first term, so we'll see where this goes. But seems like both sides are dug in.
And,
So,
and I think the longest to date in history has been like 35 days or something in the mid 30s.
yeah.
It's got to have some kind of impact on investments and the stability of the market, but it does not. So at least again, thus far, seem to be playing out that way, Tim.
No, so far it's been all okay in the market, and that makes me wonder what is going on. It's very strange times.
Is it simply like market complacency or have resiliency? Like, have we gotten so used to this happening, it seems like every 6 months or so, that the market's like, hey, it's another one, we'll make it through it.
Right. I think it's more complacency. I mean, most people think the markets just kind of keep chugging along. You and I have talked about this 100 times, but the market usually, resets around, 7 years, and we're at a good clip here. I mean, it's been 18 years basically, uh, y- you know, um, that we've seen the market just keep going up. And when it does go down, it seems to bounce back the next year. And we're seeing a lot of advisors who have never seen that. We're also seeing a lot of clients that are not remembering those days, and they think that it's just going to be like a basketball, always come bouncing back up. And I don't agree with that. We're cautiously optimistic at all times, but we're also, trust but verify. So make sure that the markets are, we have our stop losses and the levels in to make sure that, the bob doesn't fall out on our clients.
Hey, Tim, you've been around long enough, enough gray hairs there. You remember the Great Recession and the dot-com bubble, and we're
Yeah.
investing and helping people through those times. I am certain that there was a lot of people very nervous about what was going on at those times, like pro trajectories, projections for what life was about can change in downturns like that. And thankfully, as you mentioned, we've been on a great run since the bottom of the Great Recession. But we have not seen a true downturn of that nature in quite some time. Government shutdown aside, does the length of time since we've seen that kind of correction worry you at all?
The lack of time. I mean, it does. It gives me worry at all times. I mean, a lot of our clients are baby boomers, and to have the rug pulled out at this time and this juncture would be really tough.
So are you just saying, hey, yes, of course it concerns me, but we're in a perpetual state of readiness? Is that, like that the approach?
That's a better way to say it. Yes, it definitely that is true because I want to make sure that people know that we're going to be, we're not going to be perfect, but we are going to be more cautionary than these buy and hold shops that we're seeing throughout Chicagoland that are have no concept of really what the markets are about because it's been so long. I think they've forgotten.
Well, I was an investor through the dot-com bubble and the Great Recession, Tim,
Sure.
but a very much younger investor, especially during the dot-com bubble. I was just basically beginning my 401k, even back then, when I knew I had a long time in front of me, I think I still got a little gun shy. And yet I think that those that had seen the market for a longer period of time, but we're still planning on investing for even longer, like those in their mid 30s and 40s back then, were more accustomed to the ups and downs. And as long as the job was stable, they kept on investing. Whereas today, those same people are now, 55, 60. Maybe we should not have that same kind of laissez faire approach where if the market goes down, it's not going to impact me.
Well, that's one of the things we talk about in our class that, the only good news back then when you lost money is that you were much younger.
Still
And
buy
now,
it. Yeah.
we are older and we need to be more cognizant of the fact that we don't have a lot of runway to make up a loss, especially if I need to draw off of it to live on. You might be able to see, oh, well, my parents did it. Well, a lot of parents had pensions. So, that made for the point where you could they can ride out a storm a little bit better. But someone like myself and most Americans, the amount of money I have in my 401k on my last day, it's a finite amount. The only growth I'll have is hopefully the stock market, and I'll be living off of it. So I'll be grabbing money from there left and right. So we need to be a little smarter and remember history.
Well, Tim, as is usual and kind of par for the course, I have dragged you off course and down a rabbit hole here to start the program. But, ladies and gentlemen, Tim Stearns, CFP, capable of having conversations about any financial questions that are on your mind. And I think that's the point. If you've got questions, if you've got concerns, if you would like to have a personalized, custom designed, detailed, protect and grow written retirement blueprint, your plan for the future, regardless of what it holds, to help you make the financial progress you need. That is what Tim Stearns, CFP, and the team from TJ Stearns Inc. are here to provide. That's the service, that's the value, that's the opportunity that they offer here on the program. No cost, no obligation, will help you get your questions answered, get your concerns addressed, and custom design and construct that protect and grow written retirement blueprint. And all you need to do is have those questions and be serious about planning, and then pick up the phone and give TJ Stearns Inc. and Tim Stearns CFP a call. 800-640-2256, 800-640-2256, 800-640-2256, the number to reach Tim Stearns CFP, TJ Stearns Inc. You can also go online, by the way, tjstearns.com. So, Tim, sorry to derail you. Enough talk about the potential for markets to fall. The intention on today's program was to talk about the reality that interest rates are falling. A much different scenario than we were in, call it 3 years ago. 2022, interest rates rose very rapidly. They stayed high for quite a period of time, and now we are beginning to see signs that they're coming back down, not all the way down, but back down a little bit. So what do we make of interest rates? Give us the backstory here, why we are where we are, how do we get here, where do we go from here?
Well, what happened, if you remember 2 years in July, we were up as high as 9%. And what we saw is the Fed realized inflation was running rampant. So they made some serious increases that made it go, the highest I've seen it in my career. And then, what happens then is that that's a great time to invest, but not a good time to, let's say, buy a house and buy any type of property because your mortgage rates are going to be higher. Where are we at now? Well, the jobs are starting to stagnate a little bit. The jobs report, we haven't gotten it yet because the government's shut down. But what we're seeing is that, President Trump wants to see us, if interest rates go down, usually that means that it'll kick into overgear, people companies being able to invest. They can borrow money at a lower cost. And so they're able to do more things. And, it brings the economy back before the economy stalls out. And that's what he's trying to avoid.
A lot of companies operate off of borrowed money, off of financing for their research and development, for their infrastructure, for building out, for new investment. A lot of people also, Tim, rely on financing, not only day to day on the credit card, which you should try to avoid, ladies and gentlemen,
Right.
but especially for the housing market, which is a huge segment of the economy, ripple effects through almost every other aspect of the economy. And the Fed, Tim, plays a critical role in all of this because they get to set the rates. They get to make the decisions that ripple through the economy. And they've got a couple goals, right? Is that they would like to promote maximum employment, stable prices, meaning controlled inflation, moderate long-term interest rates. And it seems like we've swung wildly with the interest rates to try to impact and affect the other two. Is that the tool that they have, these interest rates?
Yes, that and their bluster when they talk. So, if it seems like if Jerome Powell looks the wrong way, the market goes down. If he talks the right game, the market goes up extraordinarily. So,
Well,
yes.
are
Well,
they taking those other mandates, the employment and stable prices, low inflation, seriously, or right now is it more of a political hockey match?
I think it's more of they're taking the reports seriously, and that's why he's so uber cautious to do anything extraordinary because they really did miss the upswing with the interest rates when they went crazy and we had inflation. I saw him on about a year and a half ago. I saw him on a interview on 60 Minutes, and he was talking about how they asked, did you guys get it wrong? And he's like, well, we were a bit delayed. But yeah, they're about 18 months delayed. So I think now, lesson learned, he's trying to be a little more cautious to not let it whipsaw the other way. And I see that and I appreciate that. But, it would be nice to see some more cuts because the cuts were, pretty, I'm sorry, the interest rates were pretty high.
So when they printed all that money from COVID, they should not have simultaneously basically made it free to access. They should have raised the interest rates at that time to make it a little bit more difficult and more expensive to access, so people would be incentivized to pay it back. Where they missed that by about 2 years, and it might have caused a little bit of pain with the inflation because all of that free money was circulating around the economy essentially.
Well, I mean, if you remember, one of the things we talked about is that back then, if you had $4 in your wallet out of 10, they had just been printed in the last, 6 months. And you wonder why inflation runs rampant. I can tell you real quick why that was. So now they're being uber cautious and they're trying not to, upset the apple cart too much, but also they don't want to see us go into a recession. So they're trying to balance that, and it's really a high wire, act, where you're trying to see, to basically do nothing is bad, and to do too much is bad. So walk that line.
Well, I know European central banks have cut their rates, I think 7 or 8 times in the period of time that we have cut ours
Right.
two or three. And yeah, we're sort of expecting another one, but the market sort of prices that in ahead of time. Like we're already seeing the impacts of that expectation rather than the reality of it being. Because when they announced the last rate cut, very little impact on the market, Tim.
Right. And to your point, it was priced in. And I think almost another thing that's being priced in is that they figured the government was going to shut down and that both parties would dig in their heels like they're doing. So, maybe that's why the markets are going back up. But it gives me pause because, in the past, it's made the market go down. So, even after 31 years in the industry, I'm still learning something, from the Fed, and it's very interesting to me. And I'd hate to be a novice out there trying to manage my own account.
Well, Tim, I know that these are things that you have to include as you are creating people's plans. So when we're talking about the Fed, the policy, the interest rate, the government shutdown, how do we plan and specifically address any of these kind of things with any relative sense of stability in our personal plans? Because when the rubber meets the road, that's who you plan for, people, real people and individuals whose financial future depends on what happens in the world around them, and we have no control over it.
Yeah, well, that's why we work with guaranteed incomes, and that's with the interest rate still being Not as high as they were about 3 weeks ago, but being at some of the highs I've seen in my career. And again, I've been in this industry 31 years. This is a great time, a excellent time to get some guaranteed income through an annuity and that type of thing. I've never seen rates this high. And that's why even old annuities, we're seeing, people are coming to us and saying, "Hey, can I basically refinance them to get a better payout?" And that's happening left and right as well. We've been busy as can be with that type of refinancing. It's not unlike when the interest rates drop a lot that refinance your mortgage. We're actually refinancing annuities.
Right. Yeah, no, no. If we wanted to get a mortgage, if we wanted to borrow money 5 years ago was the time, right? And then interest rates shot up,
Right.
where mortgages were like in the sevens and even eights. Now we've got to live somewhere, so people were still taking out mortgages, but just because the interest rate has come down since that time, Tim, it's not like your bank, your lender is going to call you up, say, "Hey, you've been such a great client of ours, great customer. We're going to give you these lower rates now, unless you refinance that mortgage." And likewise, 5 years ago, 10 years ago it was a lower interest rate and lower payout environment. Today, it's a higher interest rate and payout environment. So just like we would refinance a mortgage if it was opportunistic, Tim, you're seeing people kind of refinance their fixed income and their guaranteed lifetime income under the current conditions.
What we're seeing is people, if you took out an annuity before 2021, give us a call at 800-640-2256, and we can show you what you can do with your money right now, with interest rates being, again, very, very high. And the second highest I've seen in my career. So these are opportunities you want to take a look at, especially if you're a baby boomer that's looking to retire.
Tim, wouldn't I risk losing money if I had one of those annuities? Or aren't there penalties and surrenders for getting out of them?
Yeah, but in most cases, if they have like bonuses and that type of thing, which we have a couple products like that, it's all about income. Those will make up for it. And if you can show the reason that makes sense to move it, for example, again, that you have a higher payout, it's all about paying your bills in retirement, and that's what we're doing with people.
You're talking about the bottom line here. Are we going to have more guaranteed lifetime income as a
Yes.
result of an environment where we've got these available to us?
Exactly. And that's what we want to make sure that people understand. You really are not going to lose anything by at least doing the exercise to see if your income's going to be better. If it's not, you stay the course. And if it is, which in about 95% of the time it is, then we make the move.
So 5 years ago, it was a great time to borrow money. Today, it's a great time to take the money that you have available to you
Right.
and shop for the best interest rates, fixed interest, yield, lifetime income payouts. Like now is the time to look at these things before rates fall any further, which, by the way, if there is ever any kind of market turbulence and recession or a downturn, that is more likely one of the Fed's chief tools is to lower rates even further, right? So now a good time to look at this.
Well, they've already said that they want to meet, they're going to meet about four more times this year, and they're already still talking about doing at least two more. So if they do two more interest rate cuts, if they do that, it's going to hurt your fixed income type products. And that's why we're making sure we're letting our clients know, "Hey, being proactive, you need to get in here to see us and we'll redo it and get you more income."
So the Fed controls the federal funds rate, which is not every rate that's out there. It is the bank to bank lending rate, but it trickles down through things. And cutting rates is cheaper if you have credit, but cutting rates for income, for payout, for yield, that is going to be harmful. So again, Tim, when we're here today, talking to savers and investors who have been proactive, who have been building that nest egg, who have been accumulating assets, and they're looking into the future and considering retirement. Is it a good time to look at some of the safer, more conservative vehicles?
I think so. I mean, when you look at what bonds have done the last 11 years, bonds have been down, 7 to 8 times. So that's where, when I first got in the industry in 1994, that's where people went. to get, their income from. Well, if you're losing in there, that doesn't really make much sense. So I would rather go with a guaranteed income type product that wasn't around in 1994 and make sure that I understand where my payment is going to be made the month after I retire. I can turn on income and have it guaranteed. Sounds pretty good to me.
Um, can you talk to us about bonds and their behavior, how um, this falling, potentially declining interest rate environment might affect those bonds that were in favor 20, 25 years ago?
Well, it obviously that bonds will, those bonds 25 years ago will actually go up in value if interest rates are coming down. That's what you're talking about, right, Peter?
Right. Well, I mean, there's this relationship between bond
Oh yeah, the
values
inverse.
and then their yields, right? Is that
Yes,
yields might come down,
right.
values might go up, but what are we worried about here? And how might that relationship work into a declining market?
Well, in a declining market, then you're going to have less to live on. And that's why, I want to make sure that if I'm going to be going into certain types of bonds, you know, that would give me pause. So that's why I like the guaranteed income products that, the market, let's say it does correct, which I think it will in the next year at least. And if it doesn't bounce back, it doesn't matter to me because I've got guaranteed income. I mean, I'm not going to enjoy it, but that there again, I'm not a buy and hold person, so I would be selling out, not timing the market, just taking some of the pain out of it, and that's important.
So, Tim, falling rates
Yes.
means lower returns on CDs, on savings, on
Oh
money
yeah,
markets, those kind of things. Existing bond values may rise, but new bond yields
we'll go
would
down.
end up falling. And
That's
most
correct.
people don't own those old bonds. Most people have bond funds, which rely more on those new yields than the existing bond values.
That's right. So that's why it's a great time to get a fixed income product that has guarantees on it.
Some
And we
alternative
always
income strategies.
exactly, and that's what we use in our protect and grow blueprint.
Well, again, if you would like to get that Protect and Grow written retirement blueprint, ladies and gentlemen, give Tim Stearns, CFP, TJ Stearns Inc. a call, 800-640-2256. That is 800-640-2256. 800-640-2256. Tim, we've got a lot of debt in this country, and I'm not talking about the national debt. I'm talking about personal debt, right?
Right?
Falling rates may be good if we're on that side of the ledger, but most people who are considering retirement and looking out to try to build the security of their financial future, they're more worried about the wealth that they have, not the debt that they wouldn't need to refinance, but the wealth that they have. So again, in this balancing act, it may be a good time to look at refinancing now and locking into higher, stronger rates and payouts.
And I agree with that. Because they've said, it's not like you have to take a guess here. They're talking about cutting rates twice more this year. So this is the time to lock in. I think it's going to be a opportunity that will be lost after the first of the year. That's why we're getting ahead of this again and contacting any of our clients or people who have called into this show or people who have attended my retirement classes and telling them, how you had a fixed indexed annuity from 2020. Now is the time to refinance that so you can get a better payout.
What about pensions, Tim? I mean, there are still some lucky folks around who have chosen a career path, worked for a company that was kind enough to offer that pension. And a lot of these companies now are offering a buyout. They don't want to take the liability of a
Right.
lifetime of income onto the company, so they will just pay a lump sum. And I know that the lump sum that they offer does equate to the income that they've promised, but also the interest rates do play into this equation, correct?
Right. When interest rates are dropping, then the amount of the lump sum is going to go up. And guess what? You have the ability, if you do, to take that lump sum. I would tell anyone to do that. The example I always give is that I played basketball at an open gym with a bunch of United Airline pilots, and they were sitting in the, cat's bird seat. And then next thing you know, they were working another 10 years because they went bankrupt. That pension is not yours until you have it in an IRA for your benefit. And so I tell anyone out there, if you can get a lump sum and you can get it rolled over now, now is the time to do it. because you're going to be able to you can be in charge of that money.
Timing matters on all of these different questions and the various options that we're talking about.
Right. And that's why we're quarterbacking this and making sure people understand what opportunities are there and what hazards are there too.
Income benefits and pensions and annuities, they are rate sensitive. So while rates are still high, ladies and gentlemen, we hear oftentimes about the downside of that, but the upside is you can get higher payouts, higher lifetime income, higher guarantees. So it's a potential consideration as a valuable part of that protect and grow written retirement blueprint. Tim, that's the protect portion of it, right? We want to have some growth money, and certainly the stock market continues there in the background as part of the plan and providing for that growth over time. But the protect portion now is a really good time to look at protection of principal and protection of income.
Yeah, protection of income, and better yet, better income, and I don't think people understand that these annuities are very interest rate sensitive. And with interest rates being the highest I've seen them in 31 years, now is the time before they start cutting rates again.
Well, TJ Stearns Inc., Tim Stearns, CFP, and his team always do make one big offer on the program, and that is to help you, ladies and gentlemen, understand your money and your investment options and put together a plan, bringing the pieces together. The Protect and Grow written retirement blueprint. If you would like to get that put together, addressing the foundation for security, stability, and lasting financial confidence and the opportunity for continued growth, pick up the phone, give a call. Tim Stearns, CFP, standing by, 800-640-2256. That is 800-640-2256. 800-640-2256. You can also go online, tjstearns.com, tjstearns.com. Tim, always appreciate your time here on the program. I am sure that we will continue throughout the remainder of the year to hear a lot very near future about this government shutdown, but continue to hear about interest rates and how they'll play into our economy.
Yes, sir, Peter, and thanks for having me, and we'll talk more.
Always a pleasure. Again, ladies and gentlemen, the number to reach Tim Stearns, CFP, your certified financial planning professional and home of that Protect and Grow written retirement blueprint, 800-640-2256. That is 800-640-2256. Give him a call.
Tune into Chicagoland's certified financial planner Tim Stearns' full radio program and visit tjstearns.com for many valuable resources, including other great episodes of Chicagoland Retirement. Be sure to subscribe.
Investment advisory services offered through Cornerstone Securities, LLC. The information presented on this program is provided for informational purposes only without warranty of accuracy, completeness, or suitability for particular purpose. This program is not intended to be and does not constitute financial, investment, legal, or tax advice. This information is general in nature, not specific enough to be construed as advice. You should not make any decision based on the information presented on this program without independent consultation with an appropriately licensed professional or competent advisor. Investment in securities or the market involves a potential risk for loss of principal. Trading, therefore, may not be suitable for all listeners. Annuity guarantees are based solely on the financial strength and claims-paying ability of the issuing company. Withdrawals of growth from annuities may be taxable as ordinary income in the year it is taken. Individuals should review contracts for specific details of the product's features and costs.